Managerial Accounting, Planning and Control, Performance Evaluation. Well, we are looking at a static budget performance report, partially completed static budget performance report. Now, here's what we've got. This is a company that has a single product, and they planned to sell 20,000 units of this product in the month. So this column, the planning budget column, is their budgeted income statement based on 20,000 units produced and sold of their product. Well, the month has passed, and it's time to evaluate what happened during that month. So this column is the actual result for the period. Now, notice a couple of things about that column. First of all, they planned to sell 20,000 units, but look at how many they actually did sell, 23,000 units. So sales in units were 3,000 more than they expected. Anytime there is a difference between the budget and actual performance, that is called a variance. A variance. So in this case, since we sold 23,000 more units than we expected to sell, that is a favorable variance. So we'll label variances F for favorable and U for unfavorable. So in this case, a favorable variance. That's a good thing. Now, let's look at the cost information and the revenue information. Well, naturally, since we sold more units than we planned to sell, we would expect that our sales revenue would be greater than our planned sales revenue, and indeed it is. Actual sales revenue is $910,000 and budgeted sales revenue is $800,000. So we've got a $110,000. Again, since actual revenue was greater than budgeted, that's a favorable variance. Now, what we do not know, though, is how much of this is due to charging a different amount than we had planned for the product, a different price for the product, and how much of it is due to volume. So we're going to need to investigate this variance a little bit further to really get down to what happened here, to explain what happened and decide whether it was a good thing or a bad thing overall or not. Again, $110,000 increase, that's probably on the good side, but we need more details to fully analyze what has happened here. Now, let's look at the cost information on this static budget performance report. The planned level of cost for variable cost of goods sold, materials, labor, variable overhead, was $360,000. Our actual variable cost of goods sold was $478,400. Well, that is a large difference, $118,400. And since the actual cost was greater than the budgeted cost, that's going to be an unfavorable variance. But wait a minute, this is a variable cost. Now, by definition, what would we expect variable cost of goods sold to do as activity went from 20,000 to 23,000? Well, we expect variable cost to increase in total as activity increases. That's the definition of variable cost. So, like the sales variance up here, we need a further analysis. We can't go yelling at production and saying, man, your costs are way out of control, until we do further analysis. So, caution with static budgets and static budget performance reports. They give us valuable information, but they are limited and can easily be misinterpreted. Again, a $118,400 unfavorable variance on variable cost of goods sold, somebody would be in trouble if they didn't understand to look further. So be careful in using a static budget performance report. All right, let's look at a couple of other things. Fixed manufacturing overhead was planned to be $130,000 and actually was $132,500. So that's a variance of $2,500. Again, an unfavorable variance. And with fixed overhead, that total should not have changed as activity changed, as long as we were in the relevant range for the resources, the capacity that we were purchasing with those fixed overhead dollars. So again, this one we probably ought to look at a bit more carefully, but in essence with this one we can say somebody spent more for fixed overhead cost than was planned. Now, was it because we went outside the relevant range of activity? Maybe we had to rent some more equipment and that caused our cost to go up. And we had to rent more equipment because we produced more units than we expected. That might be a good thing in the long run, but we need to look further, look beyond just this cursory overview. And then below that, we've got gross profit, of course, and our selling and administrative expenses. Selling and administrative variable was expected to be $30,000, but remember that was for 20,000 units sold. Our actual cost for 23,000 units was $32,500. So once again, we've got a $2,500 unfavorable variance here. With selling and administrative costs, we need to look at each of the major areas within this. So again, we need to look for more detail. What specific costs did we spend more for than we expected? Which ones did we spend less for than was expected? So we need further analysis of the variable selling and administrative costs before we can take corrective action if corrective action is needed. Now, before we leave the static budget performance report, we need to finish out looking at the fixed selling and administrative expenses and the bottom line net operating income. Now, again, remember, fixed selling and administrative was for a planned level of production of 20,000, 85,000, and we looked and see that this truly is a fixed cost and we're within the relevant range because the actual cost for 23,000 units was 85,000 also. So there was no variance for the fixed selling and administrative cost. And then the bottom line, as we look at the difference between the planned operating income at 20,000 units produced and sold and the actual operating income at 23,000 units sold, we see an overall variance of $13,400. Unfavorable. Now, this is what's going to get management in an uproar. We sold 23,000 units when we planned 20,000. Revenues were higher, but the bottom line net income is $13,400 less than they expected. So that is going to have people asking questions, and we will look at in the next video a way that we can get to answering those questions.